Hello, everyone. Today, we're going to talk about an important topic, the Buffett Indicator and what it tells us about the stock market. Warren Buffett, a great investor, uses this indicator to understand the market. Right now, it's very high at 182%, well above the usual 100%. This makes us wonder about the future of the market. We'll explain how it works and what it could mean for your investments. So, stick around till the end, subscribe to the channel, give us a thumbs up, and leave your comments. We want to hear what you think. Let's dive in. 1. Warren Buffett's favorite stock market health indicator, the Buffett Indicator, is signaling a potential 45.1% reevaluation of the stock market. Let's simplify the Buffett Indicator, that fancy term used by the legendary Warren Buffett to understand the stock market. Imagine it as a super simple tool that does an amazing job. It compares the size of the US stock market to how much the entire country produces, that's the famous GDP. When this indicator goes above 100%, like it is in 2023, at 182%, it's like a warning sign. It means the stock market might be too expensive, like a sale that's over, and prices will go up again. This could mean that in the future, investors might make less money in the stock market. In the worst-case scenario, the market could even drop by about 45.1% to get back to normal. This reminds us of when Warren Buffett had already warned about the dot-com bubble back in 1999. And then the market crashed. This situation makes us think about the things that influence the market, like interest rates and how much companies make. Even with interest rates rising, the market is still up there, which seems a bit strange. How much companies make is important because if they don't grow as much as the country, it's like the market not keeping up with the size of the economy. As the Buffett Indicator shows, there could be risks for investors. But wait, the future is a bit mysterious, and there could be various things happening, like the market adjusting without a big crash. What the Buffett Indicator does is give us a valuable insight, like a lighthouse for those who want to invest wisely and carefully. 2. In 1999, Buffett warned that the stock market was overvalued during the dot-com bubble at the Sun Valley Conference but was initially ignored. In 1999, Warren Buffett gave us a great lesson about the stock market. Back then, the world was in the midst of the so-called dot-com bubble. What was that? Well, it was a frenzy where everyone was excited about internet companies that, most of the time, hardly had any real profits, but their stocks were worth a fortune. It was like the rules of the game had changed. But Buffett, known as the Oracle of Omaha for his incredible investment wisdom, pointed his finger at the hidden truth. He said that stocks were overpriced, that the values were unreal. But many people didn't like what he said, and some even made fun of him. But the bubble burst, stocks plummeted, and Buffett had been right all along. It's a story that shows us how the stock market can be a roller coaster, with everyone acting emotionally. The lesson here is that instead of following the crowd or believing in empty promises, it's smarter to pay attention to the facts and have a long-term view. That's what Warren Buffett did, and that's why he's one of the greatest investors of all time. So, remember, investing is about patience, wisdom, and solid fundamentals, not about trends and irrational optimism. 3. The Buffett Indicator is calculated by dividing the total market capitalization of the US stock market by the country's GDP. Folks, let's talk about something that might sound complicated but is a powerful tool to understand the stock market, the Buffett Indicator. You see, it's like a magical formula that compares the size of the US stock market to how much the entire country produces. The famous GDP. When this indicator goes over 100%, like it is in 2023, it sort of flashes a red light and says, be careful, the stock market might be too expensive compared to the economy. It's a tool that has proven to be a kind of radar to assess if the market is getting too high. Moreover, the Buffett Indicator teaches us a big lesson about how the economy and stocks relate. When the economy is growing, it's usually great for the stock market because companies make more money. But if the stock market becomes much larger than the economy, it can be a sign that things are going too far, that people are paying too much for stocks compared to the real economy. The bottom line is, in the world of investments, it's essential to keep your feet on the ground, look at both market valuation and the economic numbers behind it. That's what great investors do. In 2023, the Buffett Indicator is an impressive 182%, well above the historical average of 100%, suggesting that the stock market is overvalued. Folks, let's get straight to the point. In 2023, the Buffett Indicator is flashing like a warning light, marking 182%. What does this mean for us, investors? Well, historically, when this indicator goes over 100%, it's time to pay attention. Usually, this is linked to periods of lower returns in the stock market. Such a high number means that stocks are being sold at a price that's way up there, with expectations of future profits that might be out of this world. It's like saying we're expecting profits so high that they're almost like a fairy tale. Furthermore, such a high indicator also tells us that the stock market might be disconnecting from the real economy. Stocks tend to do well when they reflect the economic growth out there, but when stock prices move too far from reality, it's like the market is out of orbit. And that might mean that stocks need a correction, a return to reality, because investors will want to see more realistic numbers. We can't predict exactly when or how much this will happen, but the Buffett Indicator is like a big warning sign. It tells us it's time to be cautious and think about strategies that can protect our money in this crazy and high-risk market. 5. The elevated level of the indicator may indicate lower future returns, potentially leading to a significant stock market drop. Folks, let's get serious now. The Buffett Indicator is screaming an important signal, marking 182%. And what does this mean for us, investors? Well, historically, when this indicator goes over 100%, it's time to watch out. It's usually associated with times of lower returns in the stock market. Such a high number tells us that stocks are being sold at a price that's way up there, with expectations of future profits that might be sky high. It's like saying we're expecting profits so high that they're almost like a fairy tale. Moreover, such a high indicator also tells us that the stock market might be disconnecting from the real economy. Stocks tend to do well when they reflect the economic growth out there, but when stock prices move too far from reality, it's like the market is out of orbit. And that might mean that stocks need a correction, a return to reality, because investors will want to see more realistic numbers. We can't predict exactly when or how much this will happen, but the Buffett Indicator is like a big warning sign. It tells us it's time to be cautious and think about strategies that can protect our money in this crazy and high-risk market. In conclusion, I hope you found the video informative about the Buffett Indicator and its impact on the stock market. If you enjoyed the content and found it useful for your investment journey, please consider subscribing to our channel, giving us a like, and leaving your comments. Your opinions are invaluable and help us create even more relevant content. Remember, financial education is essential for success in investments. So, stay with us to stay updated with the latest analyses and insights. Thanks for watching, and see you in the next video.